Welcome back to the deep dive. So today we're going to shift our focus a little bit. We're not talking about what assets to buy, the exciting stocks and ETFs. We're talking about something more foundational, something that's often ignored, which is the structure, the wrapper, the actual account where you hold your investments. Our mission today is a deep dive into the source materials, comparing the three main investment structures for anyone focused on the French framework: the PEA, the CTO, and Assuranceify. We're going to try and find that perfect balance between, tax optimization, asset choice, simplicity, and of course, fees. It's a puzzle, but one that really pays off.
It's absolutely essential to get this right from the start. I think asset strategist Pierre Sabatier put it perfectly. He said, understanding the supports the accounts is already mastering a part of the asset strategy.
Mm.
And just before we plunge in, a quick but important note. This is all purely educational. We're analyzing the source material for you. It's not personalized advice, so you absolutely must do your own research.
Okay, let's unpack this then. Before we get into all the numbers and percentages, what did the sources say is the single most important factor for success? Because I think we both know it's not the account type.
Exactly. That's the core lesson that so often gets lost. Choosing the right account it can definitely optimize your returns. It can save you a fortune in taxes over the long run. But the sources are unanimous on this. What truly matters for your performance is discipline, having a coherent strategy, and just the capacity to stay the course when things get rocky.
So it's about showing up consistently, not just having the fanciest gear. But once you commit to showing up, that gear does matter. And the decision comes down to balancing four sort of competing criteria.
Right, you're always juggling. First, there's simplicity. How many accounts do you want to manage? Then there's choice. Do you need access to everything, every global stock and ETF? Third is taxation, which is huge. How much can you shield from the tax man? And finally, of course, fees, which can just gnaw away at your returns if you're not careful.
That juggling act is precisely why so many people get stuck. I mean, the sources mention this anecdote about an investor, Sandra. She knows she needs to pick the right wrapper, and she ends up spending weeks just watching online videos, obsessing over tiny differences in fees between providers.
And that's the modern dilemma, isn't it? She's focusing on optimization, saving a few basis points, but she's risking losing sight of the bigger strategic picture. If she picks a slightly cheaper account that's super complex or penalizes her for needing liquidity, she might lose that discipline that we just said matters most. So let's get into the mechanics, starting with the two big ones, the PEA and the CTO.
Let's start with the PEA, the Equity Savings Plan. This is really the tax champion of the system, but boy, do you trade freedom for that advantage.
That's the perfect way to put it. The main attraction of the PEA is, without a doubt, the taxation. If you hold the account for more than 5 years, you pay 0% income tax on your capital gains.
0%.
Zero. Now, you still pay the 17.2% social deductions. That part is unavoidable no matter what. But avoiding income tax on your gains, that's a massive, massive advantage over decades. Even dividends get that same treatment.
Okay, 0% income tax sounds like the ultimate cheat code. So where's the catch? There has to be a catch. What are the constraints we're accepting?
The constraints are pretty significant. First, there's a hard contribution ceiling of 150,000 euros. For a serious investor, you'll eventually hit that cap and need to look elsewhere. Second, and this is a big one, the investment universe is limited. You have to invest in equities or funds based in the EU or the European Economic Area.
And that's the critical limitation. So what if I want to buy into the biggest market in the world, the US, or maybe high-growth Asian companies?
You can't buy those specific stocks directly. The sources point out that to get that kind of global exposure inside a PEA, you generally have to use something like a synthetic ETF. And while those do track the global index, they introduce a layer of counterparty risk, which is a key strategic trade-off. It's a bit more complexity you accept to keep that amazing tax benefit.
And then there's the liquidity issue, which really enforces that discipline theme we talked about.
Absolutely. The liquidity drawback is the ultimate test. Any withdrawal you make before that 5-year anniversary, well, it results in fiscal penalties and, crucially, the automatic closure of your entire PCA.
The whole thing closes.
The whole thing. And since you're only allowed one PEA per person, that's a huge penalty. It really cements the PEA as a vehicle for truly long-term, untouched savings.
So if the PEA is the tax fortress with a 5-year lock-in, what happens when we need total flexibility? That brings us to the CTO, the ordinary securities account.
And the CTO is the complete opposite. It's the flexible workhorse. It offers just total, unadulterated freedom. In terms of assets, anything goes. Foreign stocks, foreign ETFs, commodities, whatever you want.
Total freedom. Any limits on contributions or how many I can open?
None at all. No contribution ceiling, and you can open as many CTOs as you want. And most importantly, it's 100% liquid. You need cash tomorrow. You sell and get it, no penalties, no account closures.
That flexibility sounds incredible, but we know freedom has a price. What's the tax hit we have to take for all that choice?
The price is giving up that tax optimization. With a CTO, the tax is immediate. The moment you sell for a gain or get a dividend, you're hit with the classic French flat tax, which is currently 30%.
30% right away.
Right away. No waiting period, no special rate. And that 30% year after year creates a pretty significant drag on your long-term compounding compared to the PEA.
That contrast is so stark, but there is a third major player that complicates the picture. Assurance vie or life insurance.
Right. And the source material often mentions that assurance vie gets left aside in these direct comparisons because structurally it's different. It's designed for savings and, importantly, wealth transmission, not just pure trading. But it's still a really versatile option.
Let's talk about the fees first, because the sources really emphasize being careful there.
This is where you have to be vigilant. Fees are generally the biggest drawback. You can have multiple layers. Entry fees, management fees from the insurer, fees for switching funds, and the underlying fees of the funds themselves. The sources use the phrase "gnaw away at long-term performance," and that's exactly what they do if you're not careful.
Okay, so if the fees are a potential landmine, where does it shine? What's the trade-off in terms of assets and tax?
For assets, Assurance vie is a kind of middle ground. It gives you access to managed funds, ETFs,
Yeah.
usually more choice than a PDA, but less total freedom than a CTO. Its tax advantage really kicks in after 8 years. After that point, you get an annual tax-free deduction on your withdrawals, which is great for capital gains.
For capital gains, specifically.
Yes, and that's a key detail people miss. The benefit is mostly for capital gains. Dividends inside many contracts can still be subject to that classic 30% flat tax. So it's not quite as tax efficient for income as it is for growth.
What about the simplicity factor, though? The idea of it being an all-in-one solution.
It can offer great simplicity, especially if you find a contract that lets you just pick your own low-cost ETFs inside of it. And of course, a huge benefit is its role in inheritance and wealth transmission. It's a fantastic tool for passing on assets efficiently, which the PEA and CTO just aren't designed for.
Okay, so let's pull this all together for the listener. We have 3 options, each with a very clear trade-off.
Exactly. The PEA, top-tier taxation, but you have to accept the limits and the 5-year commitment. The CTO, total freedom, but you pay for it with immediate, steep taxation and assurance vie. The versatile middle ground, great for inheritance, but you have to watch those fees like a hawk.
So given those compromises, what's the strategy that the source material points to as being the most efficient for long-term growth?
The analysis strongly suggests a primary strategy of PEA first, supplemented by the CTO. The goal is simple. You want to max out that 0% income tax wrapper for as much of your portfolio as you can. So you funnel all your eligible investments into the PEA until you hit that €150,000 ceiling. And only then do you start using the CTO for things that just can't go in the PEA, like specific foreign stocks.
That makes perfect sense from an optimization standpoint, but I have to push back a little, thinking about a specific kind of learner. If we go back to discipline, is the PEA really the best starting point for, say, a young investor who might need that money for a down payment in 3 years?
That is a fantastic point and a fundamental challenge. Mathematically, the PEA is superior for long-term growth if you play by the rules, but it imposes a lot of friction.
Right.
For someone starting out or someone who isn't sure they can lock up capital for 5 years, the risk of having the whole account close is just too high. So the strategic choice shifts. It moves away from pure tax optimization and more toward flexibility.
So for them, maybe the CTO is actually the better starting point, even with the tax hit.
It could be. If an investor knows they lack the financial stability to commit for 5 years, starting with the flexible CTO might be the very thing that ensures they keep investing consistently. And that's the ultimate goal, right? The best account is the one that fits your actual needs and your behavior.
It all comes back to where we started. Understanding the mechanics is one thing, but it's not going to save you from your own psychology.
Precisely. We've gone through all the details, the taxes, the limits, the fees. But the single most critical takeaway is this. It is not the wrapper that makes the performance. It's your discipline and your ability to stick to your strategy through thick and thin, no matter which account you're using.
That's the perfect note to end on. The mindset is the ultimate driver. I'll leave you with a thought for reflection from the late Charlie Munger, who was a master of focusing on what really matters. He said, take ideas wherever you find them, but use your own brain to assemble them. And that raises a really important question for you, the learner. After hearing all this, how will you balance optimization chasing that absolute lowest fee and tax rate against the psychological benefit of simplicity and flexibility? Sometimes the simpler route is the one you'll actually stick with. If this deep dive helped you connect some dots or maybe saved you a few hours of research, be sure to add a like and subscribe to the channel so you don't miss our next analysis. We appreciate you diving deep with us.